Welcome back to the channel. Today we're diving into how a liquidity trap can impact cryptocurrency prices. Let's break it down. Now, for those of you wondering what on earth a liquidity trap even is, picture this. Interest rates are already rock bottom, maybe even zero, and the central bank is pumping money into the economy, but nobody's really spending or investing it. People and businesses are so cautious or pessimistic that they just hoard cash, no matter how cheap it is to borrow. It's like the economy's engine is flooded, and just adding more fuel isn't making it go any faster. This is a tricky situation for traditional economic policy, and it creates a really unique environment for all assets, including our beloved cryptocurrencies. So the big question we're tackling today is whether this kind of economic quicksand is bullish or bearish for crypto. You hear a lot of conflicting opinions out there, and honestly, there are strong arguments on both sides. Some folks believe it's the perfect storm for Bitcoin to shine as a non-sovereign store of value, a true digital gold. Others argue that in times of extreme uncertainty and a flight to safety, highly speculative assets like crypto could take a major hit. It's not a simple answer, and understanding the different forces at play here is absolutely crucial if you're holding crypto or thinking about getting into it, because these macroeconomic conditions can and will have a real impact on your portfolio. We're going to explore several key factors, from how a loss of faith in central banks could drive people to alternatives, to the fears of currency debasement, and even how the simple act of people hoarding cash can ripple through the crypto markets. We'll look at the digital gold narrative, but also consider the very real possibility of credit contractions and deflationary pressures. My goal here is to give you a comprehensive overview so you can better navigate these complex waters and make more informed decisions. It's a fascinating topic, and one that's becoming increasingly relevant, so stick around as we unpack it all. Alright, let's kick things off with a pretty significant potential consequence of a liquidity trap, a loss of faith in central banks. Think about it. If the Federal Reserve or the European Central Bank has thrown everything but the kitchen sink at the economy, slashing interest rates to nothing, buying up bonds like there's no tomorrow, and still, the economy is stagnant, what does that tell the average person? It might suggest that these powerful institutions are running out of effective tools, that their traditional playbook just isn't working anymore. When people start to feel like the experts are fumbling, or that the established financial system is on shaky ground, they naturally begin to look for alternatives, for something outside of that system. This is where the narrative for decentralized assets like Bitcoin and Ethereum really starts to gain traction. If you're worried that your national currency might be mismanaged, or that the banking system isn't as stable as you once thought, the idea of a currency or a financial platform that isn't controlled by any single government or institution becomes incredibly appealing. Bitcoin, with its hard cap and decentralized nature, can be seen as a refuge from potential central bank missteps. Ethereum, with its burgeoning ecosystem of decentralized finance, or DeFi, offers an alternative financial infrastructure that operates independently of traditional banks. It's this potential shift in trust that could be a major tailwind for crypto. When confidence in traditional monetary policy wanes, it's not just about fear, it's also about seeking empowerment and control. People might feel that if central banks can print unlimited amounts of money, effectively devaluing savings, then holding assets that are provably scarce and operate on transparent, immutable ledgers becomes a more rational choice. This isn't just a fringe idea anymore, it's a conversation that's happening in mainstream financial circles. The inability of central banks to stimulate real economic activity in a liquidity trap could inadvertently become one of the strongest advertisements for the very existence of cryptocurrencies, pushing more individuals and even institutions to explore them as a viable alternative store of value or a new financial frontier. Now, building on that loss of faith, let's talk about a very specific fear that often arises during liquidity traps: currency debasement. When central banks are desperate to get things moving and cutting interest rates to zero hasn't done the trick, one of their go-to moves is massive quantitative easing, or QE. Essentially, they start printing money, digitally of course, on a grand scale to buy assets, hoping to inject liquidity and encourage lending and spending. While the intention might be good, the potential long-term consequence that worries a lot of people is significant inflation down the road, or what some call currency debasement. Your money just doesn't buy as much as it used to. This fear isn't unfounded. If the supply of money increases dramatically without a corresponding increase in goods and services, basic economics tells us that prices are likely to go up eventually. Savers get punished because the purchasing power of their cash erodes over time. This is where assets with a limited or fixed supply start to look incredibly attractive. Gold has traditionally been the go-to hedge against inflation and currency debasement for centuries. But in the digital age, a new contender has emerged: Bitcoin. With its mathematically enforced scarcity of only 21 million coins ever to be created. This hard cap is a fundamental part of its value proposition. So, if investors are looking at a future where central banks might be forced into even more aggressive money printing to combat economic stagnation, the appeal of an asset like Bitcoin, which cannot be arbitrarily inflated by a central authority, becomes pretty clear. It's seen as a way to preserve wealth in an environment where fiat currencies are potentially losing their value. This isn't just about Bitcoin. Other cryptocurrencies with strong tokenomics and limited supplies could also benefit from this narrative. The more people worry about the long-term stability and value of their dollars, euros, or yen, the more they might be inclined to allocate a portion of their portfolio to these digital assets as a hedge against that perceived debasement. Okay, so imagine you're an investor in a liquidity trap. Interest rates on your savings account are practically zero. Government bonds, traditionally seen as safe havens, are also yielding next to nothing, or in some bizarre cases even negative yields, meaning you pay to lend the government money. It's a tough spot to be in if you're trying to grow your capital or even just preserve its purchasing power. This environment essentially forces investors, from big institutions down to regular folks, to look elsewhere for returns, often pushing them further out on the risk spectrum than they might normally be comfortable with. This is what we call the search for yield. And where do you think a lot of that capital, desperate for some kind of return, might end up? You guessed it, potentially in riskier assets, and cryptocurrencies definitely fit that bill for many. During periods when traditional markets are offering dismal prospects, the allure of crypto's potential for high returns can become incredibly strong, especially if there's already some underlying bullish momentum in the crypto market itself. People see stories of massive gains, and when their bank account is earning them pennies, the temptation to allocate some funds to something with more exciting upside, even if it's more volatile, grows significantly. This can fuel speculative bubbles, no doubt, but it also drives adoption and brings more capital into the space. It's not just about chasing massive moonshots either. The rise of decentralized finance, DeFi, offers various yield-generating opportunities within the crypto ecosystem itself, like staking, lending, or providing liquidity, which can offer returns far exceeding what's available in traditional finance, albeit with their own set of risks. So in a world starved for yield, the crypto market can act like a magnet for capital. While some of this inflow might be purely speculative and short-term, a portion of it can lead to more sustained investment and development within the crypto space, particularly if the liquidity trap conditions persist for an extended period, making those near-zero traditional yields the norm. Chapter 4: Bitcoin, the Rise of Digital Gold. One of the most compelling narratives for Bitcoin, especially in times of economic uncertainty like a liquidity trap, is its comparison to digital gold. For literally thousands of years, physical gold has been a trusted store of value, a hedge against inflation, currency debasement, and geopolitical instability. When people lose faith in paper money or governments, they often turn to gold. So, the argument goes, if gold thrives in certain economic conditions, why wouldn't Bitcoin, which shares some similar characteristics like scarcity and being outside the traditional financial system, do the same, but in a modern digital format? During periods of economic stagnation combined with low or zero interest rates, classic symptoms of a liquidity trap, gold often performs well. Low interest rates reduce the opportunity cost of holding gold, which pays no yield. If Bitcoin truly is perceived by a growing number of investors as a digital equivalent, or even an improvement on gold, more portable, divisible, and potentially more secure if self-custodied correctly, then it stands to reason that it could benefit from the same macroeconomic tailwinds. As central banks engage in more aggressive monetary policies, potentially weakening fiat currencies, the appeal of a non-sovereign, scarce asset like Bitcoin could increase substantially, mirroring gold's traditional role. This digital gold narrative is powerful because it's easy to understand, and it taps into a long history of how people protect their wealth. If institutional investors, who are major players in the gold market, start to allocate even a small percentage of their portfolios from gold to Bitcoin, it could have a massive impact on Bitcoin's price due to its relatively smaller market capitalization. We've already seen some signs of this shift in thinking. The more this narrative solidifies, and the more Bitcoin demonstrates its resilience and maintains its core properties, the stronger its case as a legitimate store of value becomes, potentially making it a prime beneficiary in a liquidity trap scenario, much like its shiny physical counterpart. Now let's flip the coin and look at some potential headwinds for crypto in a liquidity trap. One of the defining features of this economic state is pervasive uncertainty. When businesses are unsure about future demand and consumers are worried about their jobs or the overall economic outlook, the natural human response is to become more cautious. This often translates into hoarding cash. Instead of spending or investing, people and companies prefer to keep their money liquid and safe, even if it's earning them nothing in the bank. This widespread desire to hold cash can have a chilling effect on the broader economy, and by extension, on speculative assets. If everyone is tightening their belts and trying to build up their emergency funds, there's simply less discretionary income available for investments, especially those perceived as high risk, like many cryptocurrencies. While some might be drawn to Bitcoin as digital gold, the average person might prioritize actual dollars in their bank account over anything else when fear is the dominant emotion. This can lead to lower overall demand in the crypto markets, particularly for the more speculative altcoins or newer projects that don't have the established track record or store of value narrative that Bitcoin might. Less new money flowing in means less upward pressure on prices. Furthermore, businesses suffering from low demand and uncertainty are unlikely to be making big, bold investments, including exploring or adopting cryptocurrency solutions or adding crypto to their balance sheets, unless it's a very specific strategic move. The general mood is one of risk aversion, so, while some capital might seek yield in crypto, as we discussed earlier, a larger, more dominant trend could be a flight to the perceived safety of cash. This reduced economic activity and lower propensity to take risks can create a drag on crypto prices, or at least lead to a period of consolidation or choppiness rather than a strong bull run, as the speculative fervor that often drives crypto rallies subsides in the face of broader economic gloom. Another serious concern in a liquidity trap is the potential for a credit contraction, and this can be really bad news for assets considered risk-on, which definitely includes most cryptocurrencies. Here's the scenario. Central banks have made money incredibly cheap to borrow, but banks themselves might become extremely reluctant to lend it out. Why? Because in a stagnant or declining economy, the risk of borrowers defaulting on their loans shoots way up. Banks get scared about their own balance sheets and future profitability, so they tighten their lending standards significantly, even if they're flush with cash from the central bank. This reluctance of banks to lend means that credit, which is like the lifeblood of a modern economy, starts to dry up. Businesses can't get loans to expand or even to cover short-term expenses. Consumers find it harder to get mortgages or car loans. This overall deleveraging and tightening of financial conditions creates a risk-off environment in the broader markets. Investors tend to flee from assets they perceive as speculative or volatile and flock to what they see as safer havens, like government bonds, even with low yields or cash. Unfortunately for crypto enthusiasts, in the eyes of many traditional investors, cryptocurrencies are still firmly in that high-risk, speculative category. So if we see a widespread market aversion to risk, crypto could suffer significantly. It's not just about less new money coming in, it could also mean existing investors decide to sell their crypto holdings to reduce their overall portfolio risk, or to meet margin calls if other parts of their portfolio are crashing. This kind of deleveraging can cascade through markets. Think about it. If big funds or even individual investors who borrowed money to invest in crypto, leveraged positions, are forced to sell, it can lead to sharp price declines. So, despite the central bank's efforts to pump liquidity, if the private credit market seizes up, risk assets like crypto could face a pretty strong headwind. Finally, let's talk about a really tricky and somewhat counterintuitive threat in a liquidity trap: deflation. Deflation is the opposite of inflation. It's when prices for goods and services are generally falling. This might sound good at first, your money buys more. But it's actually a very dangerous economic condition. If people expect prices to be lower tomorrow, they delay purchases today. Businesses see falling prices and profits, so they cut back on investment and hiring, which further reduces demand, creating a downward spiral. This is a hallmark of severe economic stagnation, and it can be incredibly difficult to escape. Now, how does this relate to crypto, particularly Bitcoin, which is often touted as an inflation hedge? Well, if deflation takes hold, cash itself becomes an appreciating asset. If prices are falling by, say, 2% a year, just holding onto your cash means its purchasing power is increasing by 2% a year without taking any risk. In that kind of environment, the urgency to find an inflation hedge like Bitcoin might diminish, at least in the short term. Why take the volatility risk of Bitcoin if your dollars, euros, or yen are gaining value just by sitting in your bank account or under your mattress? This is a crucial point, because many of the bullish arguments for Bitcoin revolve around its ability to protect against the loss of purchasing power due to inflation or currency debasement. If the primary economic threat shifts from inflation to deflation, at least temporarily, then the narrative for holding Bitcoin as an immediate hedge might weaken. People might prefer the certainty of appreciating cash over the potential, but uncertain gains of crypto. Of course, long-term, if the deflationary bust eventually leads to even more extreme monetary stimulus and renewed inflation fears, Bitcoin could still shine. But in the throes of a deflationary liquidity trap, the immediate appeal of cash can be a powerful competitor to risk assets, including our digital gold. So as you can see, a liquidity trap doesn't paint a simple black and white picture for cryptocurrency prices. It's a complex interplay of various forces, some potentially bullish and others decidedly bearish. On one hand, the erosion of faith in central banks and the fear of long-term currency debasement could absolutely drive significant capital into assets like Bitcoin, pushing prices up as people seek out non-sovereign stores of value. The desperate search for any kind of yield in a zero-interest rate world could also funnel speculative money into the crypto space, fueling rallies, at least for a time. However, we also have to consider the other side of the equation. The overwhelming economic uncertainty can lead to cash hoarding, reducing the appetite for speculative investments. If credit markets freeze up and a general risk-off sentiment takes over, crypto, as a volatile asset class, could face significant selling pressure. And perhaps most counterintuitively, if deflationary pressures become dominant, the appeal of holding appreciating cash might, in the short term, outweigh the need for an inflation hedge like Bitcoin. It really highlights how crypto is still finding its place and reacting to these larger macroeconomic shifts. So, the net effect on crypto prices really depends on sentiment and policy reactions. If people see crypto as a hedge against broken systems, it could be bullish. But if deflation and risk-off sentiment dominate, we might see bearish or choppy markets. Thanks for watching, and don't forget to like and subscribe for more insights.